Breaking! The Iran war and the Hormuz blockade did not come out of nowhere. The dollar was already on life support. This may have been a desperate petrodollar play. Control the choke point, force oil to continue in dollars, reinvigorate the reserve currency. It backfired spectacularly, and this is why this might be the event that actually begins the dollar's endgame. This morning, as we are recording this, the United States military began its blockade of the Strait of Hormuz. Not threatened to, not warned about it, began 10 a.m. Eastern Time. Oil is back above $100 a barrel. U.S.-Iran peace talks collapsed over the weekend. Bitcoin wrecked, sitting at 71K, down about 3%. And the dollar is, up. The dollar is actually up today. And Wall Street is calling that good news. I want to talk to you about why that is not good news. I want to talk about why everything you're seeing right now, the war, the blockade, the oil price, the dollar strength, is actually the story of an empire performing CPR on a currency that has been dying for years. And why the thing they used to try to save the dollar may have just destroyed it. Welcome to Simply Bitcoin. I'm Rustin. Big show today. Let's get to it. Send it. When this war started, something felt off. And I don't mean strategically off. I mean narrative off. The stated reason: Iran's nuclear program that's been there for decades, the sanctions, the standoffs, the brinksmanship. We've seen it all before. And yet something about the timing, the abruptness, felt completely disconnected from the surface level story. Most people couldn't put their fingers on it, and I want to be real, even in our community. The discourse defaulted to the familiar geopolitical chess, regime change, nuclear deterrence, the stuff that feels like an explanation. Now, before I take you through today's thesis, I want you to think like Simon Dixon and ask yourself this simple question: who actually benefits? Not who says they benefit, not who the media says benefits. Follow the money all the way down. And when you do that, when you trace the actual capital flows, the actual beneficiaries, the actual power dynamics, a completely different picture emerges. We are not watching a Middle East conflict. We're watching a financial system fighting for its life, using the military as its instrument. And that changes everything about how we should be interpreting every single headline you're reading this morning. Let's establish the baseline, because this is where the story actually starts. Right now, the US dollar represents 46% of global foreign exchange and gold reserves. 46. That is the lowest level in at least 26 years, and it has been at a structural decline for 2.5 decades. In the year 2000, the dollar dominated global reserves. By 2026, that dominance has been cut in half. And this is not my opinion. This is IMF data. At the same time, the United States government needs to refinance $10 trillion of debt in the next 12 months. $10 trillion maturing this year. While oil is at $100 a barrel, while treasury yields are back above 4.4% on the 10-year, while the Pentagon is asking Congress for a $200 billion war supplemental. Miss every shot you don't take or something, right? While gasoline inflation is running at 21.2% annually as of March 2026, CPI data. That is the situation. And here's why it matters for the war. The petrodollar system, the architecture Henry Kissinger built in 1974 when he cut the deal with Saudi Arabia. We talked about this last time. It is the load-bearing wall of American financial hegemony. The deal was elegant and brutal. You price your oil in dollars. We protect you militarily. The world needs oil. The world needs dollars. Dollar demand is guaranteed. American debts get absorbed globally. The machine runs forever. Or so we thought, because except the machine requires something. The world must choose to price oil in dollars. That choice can be unmade. And as the dollar's share of global reserves has fallen from over 70% to 46%, that is the existential threat. And that is what you have to understand what's happening in this war.
So look, this is definitely the big one.
Yep.
So there's obviously, we've talked about this proof of weapons network. You have a financial industrial complex that profits from financing wars and then rebuilding. You have a military industrial complex that profits from both war and defense. And then you have a technical industrial complex, which is currently using algorithms as like a new media and new data play in order to, build out our police and surveillance state. And I call that a proof of weapons network in previous episodes because Bitcoin proof of work is the resistance against it. Firstly, you talked about we've got this big geopolitical transition that I've been talking about for years that other people believe is happening, which is this transition to a multipolar world.
Versus FIC, military industrial complex versus financial industrial complex. Two entirely different factions with different incentive structures, both operating through the same US government and increasingly pulling it in opposite directions. Simon's argument, and it's meticulous, is that the financial industrial complex is not interested in perpetual war. The FIC wants regional stability. They want to build. Think about who's in the camp. That's asset managers, sovereign wealth funds from the Gulf, the architects of the Build Back Better reconstruction economy that follows any major conflict. For them, peace is profitable. War is friction. The military industrial complex, they need the conflict. Like Lindsey Graham, you gotta inject it in his veins, or he starts foaming at the mouth. But depleted missile stockpiles, congressional supplementals, Raytheon contracts, every Tomahawk that gets fired is a Tomahawk that has to be replaced. At roughly $2 million a unit. Here's the wrinkle that Simon layers in, and I want you to hear it in his words.
Because if you think this is about, religion, if you think this is about a nuclear program for the last 40 years we've been told is 2 weeks away, this is about energy. And it's always been about energy because whoever controls the energy and the flow of that energy, i.e. the ports, controls power in their region, in their hemisphere. And so that's kind of like the entire backdrop to help you analyze and understand this.
Energy. Not religion, not nuclear deterrence, not democracy, but democracy. Energy. And specifically the pricing of energy, because here's the thing, most people have missed it. It is not enough to control energy production. You have to control the currency in which energy is denominated. What was that thing Meyer Amschel Rothschild said? I care not who writes the laws, let me control the nation's currency. Well, that's it. That's it in action. That is the petrodollar mechanism. That is the entire game. If oil is priced in dollars, the world needs dollars. If oil is priced in yuan, the world needs yuan. If tolls are paid in Bitcoin, you need Bitcoin. That single variable, the invoice currency on a barrel of crude, is worth more to the United States government than any treaty, any tariff, any sanction regime, because it determines global demand for the dollar itself, and it's being challenged directly in real time today. Now here is the thesis of today's show, and I want to be clear, this is me connecting some dots, kind of autistically, low on the spectrum. But this is the framework, not a government memo, but when you follow the money the way Simon Dixon taught us, the dots connect. Even for the differently abled like myself. The United States is sitting on massive proven oil and gas reserves. The Permian Basin, offshore reserves, LNG export capacity that has been scaling rapidly. America is quietly, structurally positioning to be a major energy exporter, not just a consumer, an exporter. Now, if you're a declining empire whose reserve currency is under existential pressure, and you happen to be positioned as a major oil exporter, the math on the petrodollar looks very different than it did in 1974, because in 1974, America needed OPEC to price in dollars so that OPEC's buyers would demand dollars. But what if America could become the swing producer? What if the oil flowing through global trade routes was increasingly American oil priced in American dollars? The Strait of Hormuz controls 20% of the world's daily oil supply. Every barrel that passes through that strait, Iranian, Saudi, Emirati, Kuwaiti, passes through that choke point. If you control the choke point, you control the conversation about how those barrels get priced. Is that why they don't seem to care about oil at $100? About your cost of living going up? Because if the plan is to be the world's swing energy exporter, high oil prices are good for you because you're going to be the one collecting, well, the the state is. That is a rational, ruthless petrodollar survival play. Control Hormuz. Force oil pricing back to dollars. Reestablish global dollar demand. Buy the dying empire another 20 years. Except something went wrong. Something went very, very wrong. Iran looked at the situation and said, fine, you want to play choke point games? Iran is now, today as we record this, reportedly offering to allow tankers through the strait on one condition. The oil must be priced in Chinese yuan, not dollars. Yuan. That is not just a negotiating tactic, by the way. That is the petrodollar receiving a wound that doesn't close very easily. Not to mention the Bitcoin toll booth. So brilliant. If you watch our last episode, the Orange Man thought it was such a brilliant idea that first offered a joint venture. Then he attacked the idea, then decided to set up their own blockade and toll Iran's blockade and toll. And remember what I told you last week, pay the toll or get blown up. Well, they did it apparently. And yeah, if this all seems insane, I think it's supposed to.
Markets are very slow to supposedly discount news, but when they catch up, they move violently, either up or down, depending on the news. And my expectation is that the markets have not even come close to incorporating what's actually going on.
Markets have not even come close to incorporating what's actually going on. Wall Street analysts have been predicting this war ends in 2 to 3 weeks since week 1. We are well beyond that, Jerry. And the strait is being blockaded. Today, the energy deliveries that were already in transit from before hostilities began have now arrived. There is nothing in transit to replace them. Rickard said something else I think you need to hear.
There were a lot of vessels underway outside the Persian Gulf when the war started. If you're going from the Persian Gulf to South Korea, that takes 2 or 3 weeks to get there.
Yep.
So there was a lot of energy in transit outside the Persian Gulf, heading to Japan and South Korea and China and other locations that kept arriving after the war started. Now there was nothing behind it. So we're just now at the point where the last shipments have been unloaded. The reserves, whatever they may be, are full. And only now, not the end of February, but today is when they actually run out of new energy because nothing has left the Gulf since then. So that chain, if you will, of vessels on the way, the last one has arrived and unloaded. There's nothing behind it. Now you're going to start to use up your reserves and you won't have anything left. And you're getting closer to turning out the lights in South Korea and Japan and elsewhere in large segments of the economy. I promise you the market has not discounted that. So there's just so much, even if we had peace, love, and understanding in the Persian Gulf, which I don't see happening, but let's just say it did. The damage that's already been done and the disruption that's already occurred is going to power this inflation. We're going to get inflation. They're all different. There's all different causes of inflation. It can be driven by velocity and the quantity theory money, but in this case, it's being driven by supply disruption. But so what? It's the price is going up and it's going to stay there.
South Korea, Japan, Taiwan, these nations import essentially all of their energy. A significant portion of that through Hormuz. When those last pre-war deliveries run out, nothing comes. And these are not small economies. These are manufacturing hubs of the world. This is where your semiconductors come from, your vehicles, your electronics. The markets aren't pricing a scenario where the lights literally start going out in East Asian manufacturing, but Rickards is. And he said something I want to add to this. He said the cure for high oil prices, unfortunately, is high oil prices because eventually you get a recession. A recession so severe that demand collapses, but this time he thinks you get something worse than a recession. He called it, quote, a global monetary collapse and a global depression. Probably nothing, and by late summer or fall of this year.
The most recent numbers, so it's early April. We're just now going to get some March data coming from different government agencies, and that's going to start to pick up the inflation, but that's going to get worse when we get to early May and we get the April data. It's going to be up, probably double digits or higher. Now the question is, does that stick and get well? The price level sticks. That's the thing. Even if inflation goes down,
Correct.
it doesn't mean prices are going down. You're at a permanently higher plateau. It may go up at a slower pace, but it's still going up cumulatively over what we've already experienced, number one. Number two, that might not slow down anytime soon. But the bigger question, I think the one you're getting at is, okay, but does it turn into hyperinflation? Does it go to 20% or 25%, et cetera? That's more, the answer is probably not, but something
Okay.
worse will happen,
Oh,
which is global monetary collapse and a global depression. Which is what happened in the Great Depression. In
mm,
other words, I don't like cliches, but sometimes they work. The saying is that the cure for high oil prices is high oil prices.
yeah.
When the price gets up, everything else slows down. Unemployment goes up, GDP growth crashes, stock markets crash, and then the price of oil comes way down again. But so what? Okay, great. The price
Damage
of
is
oil is
done.
way down. Everyone's unemployed. You don't even need gasoline if you're out of a job.
Hey, quick word from our partners at Ledn, because everything we're talking about today is exactly why you may need liquidity in the future. And you do not want to sell your Bitcoin. Ledn has been the gold standard in Bitcoin-backed loans for over 8 years. Over 10 billion in loans. They custody your Bitcoin. They don't lend it out for a yield. No fine print, no penalties, auto top up on your position, and the rates they're offering right now, there's nowhere else I'd trust to use Bitcoin as collateral. While the dollar is at 46% of global reserves and the bond market is losing its mind, Ledn is one of the places where Bitcoin denominated financial services actually make sense. Check them out by scanning the QR or clicking that link in the description. Okay, Lynn Alden and Luke Groman, and if you're not following these two, you should be. They put an episode out last week, and the thing they focused on mostly that people are missing, it's not about the oil prices. It's about the treasury market. I mean, all of it. Stablecoins to create demand because the demand is erasing. Hormuz forcing people to buy oil and like coercing because there is no organic demand. Here's what I mean. The dollar doesn't just derive its power from oil. It derives its power from US Treasury bonds, which the entire world holds as the ultimate, quote, safe haven reserve asset. That system depends on global confidence that U.S. treasuries are safe, liquid, and will be honored. Right now, that confidence is cracking like crazy. It's spreading. The 10-year treasury yield has shot above 4.4%. The MOVE index, the bond market's volatility meter, has spiked to what RSM's chief economist called levels consistent with price instability and policy dysfunction. Treasury auctions in the last week showed weak demand across 2-year, 5-year, 7-year notes. And here's the killer detail from Fortune. The US has 10 trillion in debt maturing in the next 12 months that must be refinanced at whatever rate the market will accept, which is now higher because war. Lynn Alden's core thesis, and this is what I want you to remember, is that Iran doesn't need to beat the US military. Iran just needs to wait because every week this continues, the US has to borrow more in a market that is increasingly demanding more yield to hold US paper, in an environment where the war itself is driving the inflation that makes those yields inadequate.
No, I think what Lynn said is right, which is and that's I think it's real important that it's that second derivative that so many people are not watching, which is all of this is happening at a time where through the first 5 months of fiscal 2026 for the US government, they were already at over 100% of receipts just on interest expense and entitlements. So we literally need to print money basically to cover interest and entitlements through the first 5 months of the year. Now there's some seasonality to that, of course, with April 15th taxes. So we're going to get that bump back below 100% here. We better. But I think we will. But the point here is that we're in a position, whether it's 95% or 100%, 105%, doesn't really matter. You have a recession, a deflation, a recession in receipts, which you will if this goes on long enough. For exactly what Lynn said, right? You're going to see, you're going to see funds, the inflation of energy and food is going to cause deflation in other things, and then you're going to get a decline in receipts. You get a decline in receipts, and now you're into the sort of debt spiral dynamic that we saw during COVID, where it gets 105, 110, 115% of receipts, and you have a decision in the United States of America and everywhere else, which is, now U.S. is one of the biggest debtors, so it's going to start, probably here or Japan, but what do you want to do? Do you want to default on entitlements? Do you want to default on treasuries, or do you want to print the money to pay the interest and to pay the entitlements? And that's what we're looking at. And that's where you end up with this big print.
I think because they're already providing some liquidity. So far, we're not really seeing usage of the Fed's repo facility. We're not really seeing credit swap lines being used, but those are, I would monitor those to see signs that's heating up. So far, it's not, but if this goes on long enough, they certainly could. And then to Luke's point, the other mechanism is treasury buybacks. Now, duration neutral treasury buybacks are not, they're more a very minor liquidity boost. You're basically, if say hypothetically you're issuing 5-year notes, on the run 5-year notes, and you're buying back off the run 5-year notes. It's not great optics, but it's a quantity neutral liquidity boost to the treasury market. But yeah, if you're buying 5 and 10-year notes and you're issuing T-bills to do it, you're reducing total duration in the market. You're basically doing the emerging market playbook where nobody wants to buy your long-term debt, so you have to issue more of it on the short term. That has other effects. Like, that's part of the reason why the Treasury General Account's so big, is because they've got to roll over these T-bills so frequently. And so that has effects. And so if you reduce, and it's funny because of course Bissent was critical of Yellen for having so much kind of shorter term treasury exposure, and kind of vowed to fix that. But it's like you say something and then you do another thing. You also talked about the 3-3-3 deal, which is not going to happen. And so yeah, we are kind of entering various phases of monetization, starting with the gradual print that kind of began in late last year. Nothing particularly new at the moment, or rather the size of the treasury buyback was interesting for sure. The longer this goes on, I would be watching some of these standing facilities or the move index and other signs of stress, because if you do get treasury yields breakout, if you do get illiquid markets, the Fed will step in as needed. They'll increase purchases. They'll expand the size of their standing facilities, whatever it takes to not have a failed treasury auction, to not have acutely liquid treasury markets or interbank lending markets.
The bond market is the constraint, not the oil price, not the military capability, the bond market. And as Rickards has said for years, the bond market remains undefeated. So here's what you do with all this. First, you stop what you're doing and head to the Bitcoin way, because if Bitcoin is now being used as a geopolitical settlement layer, and it is, then you need to understand that the same property that makes it work for Iran, for the United States, it makes it work for you, for Michael Saylor. Bitcoin held in self-custody cannot be frozen, seized, restricted. Bitcoin held on an exchange, that exchange is one government letter away from freezing your account. Iran can't hold Bitcoin in a U.S. bank, but they can hold it in self-custody. You should too. Hardware wallet, your keys, your coins. The Bitcoin way sets you up with ironclad self-custody. Proper hardware, your own node, full on-chain verification, so your Bitcoin is actually yours. Not your bank's, not an exchange's, yours. Their team guides you through the entire setup, step by step, until you mastered it. Oh, and they can help with privacy phones, Plan B residency, and so much more. No single point of failure standing between you and your generational wealth. Book your free 30-minute consultation right now by scanning that QR code or clicking the link in the show notes, and begin your journey towards sovereignty today, the Bitcoin way. All right, here we go. Bitcoin is the only monetary system on Earth that is not subject to any of this crap. You can't inflate it. There is no Federal Reserve of Bitcoin that decides to print more when the Pentagon needs 200 billion or whatever the hell. They can't even pass an audit. You cannot seize it because it's held digitally in a European custodial account. Ask James Rickards how that worked out for Russia's 300 billion in treasury reserves frozen in 2022. Rickards actually praised Russia's central bank chief as the only central banker in the world who actually understands her job, because she spent years accumulating physical gold that could not be frozen. Gold is the nation-state version of that principle. Bitcoin is the individual version. Unseizable, uninflatable, non-negotiable.
Your job is to get as much Bitcoin as possible over the next 10 years, because this 100% ends in a self-custody play.
Self-custody, proof of work, the only system nobody can manipulate, nobody can block, nobody can print more of when they need to fund a blockade of a strait that was already blockaded. And here's what is happening today in real time that makes this even more urgent. Iran is offering to allow tankers through Hormuz under one condition: oil priced in yuan. Toll paid in Bitcoin, not dollars, yuan, Bitcoin. If that trade begins to flow at scale, if the world's most critical energy choke point currently now begins routing oil through yuan and Bitcoin denominated transactions, the petrodollar takes a wound it has never taken before. Not a setback, not a challenge, a structural wound. The dollar is at 46% of global reserves. It was at 71% in 2000. The trajectory is not ambiguous. And if you model what happens when the global wealth, even a fraction of it, rotates out of a declining dollar system and into an asset with a 20 million hard cap, with no central issuer, with no war chest that can be rated, the math that gets you to $1 million Bitcoin is not a meme. It's the arithmetic of a monetary system failure finding its exit valve. They tried to save the dollar with a war. The war may have buried it. The yield on Bitcoin is freedom. Hey, Bitcoin protects your wealth, but it won't keep you connected when the grid goes down. But thanks to our friends over at Sat123, they got you covered. Sat123 fixes all that. Satellite phones, Starlink kits, Faraday bags, and backpacks. They built everything for people who take sovereignty seriously. Use code SIMPLY at sat123.com for 15% off. That's sat123.com. Use code SIMPLY. Debt requires growth. Growth requires inflation. Inflation requires petrodollar demand. Petrodollar demand requires control of the choke point. The choke point is being contested, and the dollar's share of global reserves keeps on falling. They used the war to save the dollar. The war actually accelerated the dollar's demise, and the exit valve for every dollar that leaves that dying system is harder money. Gold for nations, Bitcoin for the people and nations. Stack it, self-custody it. Don't trust anyone else to hold it for you. And you gotta be kidding me! Look at our likes!
3 or 4 times, maybe.
I gotta pump those numbers up. Those are rookie numbers in this racket.
Pay the like toll! Subscribe if you haven't, and give us a pamp. Share this episode because most people in your life are watching oil hit $100 today and thinking it's temporary. It's transitory. It's not transitory. It's the system, and now you know why. Comment, let us know what you think down below. Set those notifications. Got a lot of great stuff. And a couple of surprises coming your way, so stay tuned, and I'll catch you all next time. Love you guys. Peace.
If you prefer to go down with the ship, you.